And given all the recent events with the Silicon Valley Bank, Credit Suisse, a lot of mess happening in the markets, I decided to welcome on the stage a professional in risk management and a recent graduate of the Erasmus School of Economics MBA, Vicente. Hi,
Yeah,
welcome.
Andrea. Hi, thank you. Thank you for having me. How are you?
Yeah, I'm feeling pretty good and super interested about what you're going to have to say about all of these things that we have seen on every possible media. A lot of people talking about it, and we hope of making some clarity on all of these topics. You ready?
Yeah, sure. These days has been, like with a lot of news and very active about this whole situation in the worldwide banking system, no?
Yeah. Do you want to present yourself a little bit more and tell us what your background is and your experiences?
Yeah, sure. Thanks a lot. Again, thanks for having me in your space. And I would tell you, I'm from Colombia. I already have 12 years experience, starting my whole career at Fitch Ratings, working with the financial institutions and the structured finance team. Afterwards, working with a couple more of financial institutions related to mortgages and a couple of leasing companies. I'm a person who has have experience in very different roles, passing by the risk divisions, operations, finance, and my last role was focused in business development as part of a G Capital former subsidiary. And so, yeah, definitely, I'm really passionate about all these financial topics since I was in the university, now finishing my MBA program with the Rotterdam School of Management, and I'm very happy now to share some minutes with you.
Great, great. Which experience among those you had in the past, those many, would you say has enriched you the most?
Erase me the most?
Enriched your preparation. Yeah.
I mean, I would say that it was a whole staircase, let's say, because Fitch Ratings give me the opportunity. I was really fortunate because of it to have like this broad perspective about how the financial industry works and how a financial institution is managed, and the strategy, the type of asset that you can manage in that kind of institutions, liabilities, the capital, etc. And then I moved to 3 different companies that gave me the opportunity to actually be part of the field, So instead of just being on the top,
get in the game,
surveillance team, exactly. So just receiving the ball and start to game with it, to play with it.
Great. So I would ask you to start to walk us through the main events of this whole Silicon Valley Bank crisis, if we can call it like that.
Yeah, sure. Well, I would say that this is a very particular institution. It was a niche bank founded like 40 years ago, and they have had a really close relationship with the tech industry in California and in general now in the US. And I would say that maybe it was a loss definitely for the tech industry in terms that they gained through the years the knowledge to understand how this industry works, especially because you heard that you have so many startups and very small companies and small initiatives that they raise every single day, and they had this knowledge to understand what are those who will have a good perspective, a good approach for their ideas. So, but I'm definitely confident that someone else will take advantage of that technology and incorporate it to their institutions. The whole story about the fall of SVB, I think that started in 2020 when we were living the pandemic. And for sure, you remember that the tech industry was a mainstream industry since we all were in lockdown, and a lot of digital solutions came up from everywhere. And a lot of investment just fell into what you can consider the technology industry. Sorry about that. And definitely this bank received a lot of money because of those investments during that year, no? And not only in 2020, also in 2021. Actually, I checked a couple of figures that the Financial Times presented in some article in the recent weeks. They rose from 102 billions in deposits to 189 billions at the end of 2021. So literally, they almost double the amount of deposits that they receive at that period of time. Obviously no, but the point is they manage a lot of banking accounts that these tech entrepreneurs, companies, or the well-established companies, they receive for all these investors, and they use that bank actually for the daily routines that they need to conduct for their business, no? So what happened? The thing is that there was a vast amount of money available, and they need to allocate somewhere. Usually, the banks, they took part of that money that they receive as deposits and make this whole assessment about the stability of those deposits, and consider that part of it can be distributed as loans or credit operations, no? So there are, for sure, the professionals that work with the SVB, very well trained and very capable on trying to forecast how much of that money they would expect to be withdrawn in the future. And they consider, okay, so maybe a good strategy for us is to actually invest in a very particular type of assets that they actually had at the end of 2022 around of $91 billion invested in mortgage-backed securities, which usually are the type of issuances that has a higher interest rate paid to the investors compared to what you can find in US treasuries or very typical plain vanilla investments, no? However, with a really high quality, we have passed over these years with all the, after the 2008 year that we had this financial crisis with the decadence of very low credit profile mortgages. Nowadays, the structures are completely different, I would say. And definitely they consider a good option, no? Now, the point is that you could expect that a big portion of those deposits can be available to withdraw anytime. And that's what actually happened during 2022. They dropped the amount of those deposits that I mentioned from 189 billion to 173 billion. So it's a vast amount of money that they need to de-invest, no? To actually return the deposits to those companies that require the liquidity for their daily operations, or maybe just because, as we heard the past year, no, the technology industry, the tech industry, the expectation is that not necessarily keeps growing at the same pace that we thought at the beginning of 2020 or 2021. And
or surely not constantly, like it may still grow as much as that, but with ups and downs, right?
Something that I read in I think that was part of an article in CNN, is that eventually you saw all these rocketing prices from tech companies, Tesla, etc. No, because those are funded about the expectation what will happen about the companies in the very fast future, and it depends on the approach of each one of the analysts. You take 10 years, 20 years or so. However, the point is that the capitals usually move really fast, no? And I'm not saying that literally they lost all the deposits that they gained during the 2020, the year 2020, no? So definitely just because of the operations, because some people just saying like, hey, you know, I require more money than I was expecting. And then they had to cancel or to liquidate these investments. Something that is very important to understand at this point is these long-term investments, usually the financial institutions, they registered to the maturity, and they obviously keep evaluating what is going on with those assets during time. But in the balance sheet, you show them with the face value that you originally registered when you buy it, right? Yeah. So the whole thing is
the value you paid for.
Exactly, the value that you pay for. So you're accruing the interest or the revenues that you are expecting from those from those notes, and actually those notes are high quality notes. They have been paying on time, and they behave properly. But the point is that if you need the liquidity today of those notes, you need to make a new exercise, no, that depends on the interest rate that is in the market during the moment that you're liquidating those notes, no? And that is where, in this whole scenario, the rise in interest rates that we are living in the world because of the inflation is starting to play part of it, and that situation generates a decrease in the valuation, the current valuation of those notes, which is basically how the finance game is reflecting that situation. No, so at the time that they bought these kind of assets, the interest rates were really low because the Fed and all central banks had been rising the interest rates. These notes have lost value in the present value, no? So if you don't need to liquidate them, you just keep following the same register, you keep receiving the earnings or the interest that you're expecting, and nothing is necessarily is not a bad thing for you eventually. But if you need to liquidate it, then you need to reevaluate those assets, and eventually the price will drop. The huge thing with this bank is that, as I mentioned, they had 92 billion in mortgage-backed securities, and they have it registered to the maturity. And the valuation of those assets at the end of 2022 presented a decrease of 15 billion, no, which is a huge amount. And it's a huge amount because you usually have these kind of notes that are reflecting the mortgages that you can find in the market that are for 15, 20, or 30 years.
Because it's 15 out of 90, so it's around like 20% value decrease, right? So it's significant.
Exactly, it's significant. It's significant, and eventually you don't know how much money your clients will withdraw in the following years. And as I mentioned, this is a very long-term investment, no? So yeah, obviously, since they are a niche, they were a niche bank, they would expect certain stability on their deposits, but maybe they didn't anticipate properly that a vast amount of those deposits will start to come out of the band really quickly, no? And eventually, the final step on this is that some institutions like rating agencies Some analysts in the market start to point it out, this situation, and that is more information available for investors, more information available for clients, more information available for the public audience, and it starts to generate a snowball. And that's how the bank runs usually emerge in this kind of situations. No, just a lot of information, sometimes wrong information, sometimes very accurate information that something is happening with this kind of institutions, and just people start to get to become scared, no, and fear and run, and literally is going to the bank and please give me my money.
Yeah, and how much do you think this is due to the fact that it's sector concentrated? Because a lot of people criticize the risk management of SVB because it was just focused on the tech sector. But the fact is, bank runs happen not just for people who are in tech, right? A lot of people can get scared if they're worried that their bank doesn't have the liquidity so that they can have their money back when they want. So how much of that is due to sector concentration risk management? And second of all, how much could they avoid that? Because they are located there. And if you get clients that are always on that side, and you can't get clients on other industries, what do? You say no to those clients? Is that a good strategy? You're reducing your clients, but you're not changing your allocation, right?
Yeah, no, I will tell you that definitely that is the unique story that each financial institution has. So the point is that, especially when you're a niche institution, you need to understand what could be the dynamics that are part of the industry that you're concentrated, no, or the type of clients' behaviors, no, that you're concentrated. And definitely it's not saying, hey, no, please don't deposit the money. No, I can say that definitely the excess cash flow that they receive, especially the companies now, I mean, for more than 250,000, that is the security deposit. No, the insurance deposit that the U.S. government has for the individual amounts that they have in a financial institution. That limit is very low for a company. It's very low for a company. 250,000 could be just a quarter or just a tenth of the payroll that they need to disburse to their employees in a monthly basis. No, so definitely each one of those clients that this bank has, they had a lot of money on top of that limit of 250,000. So the point is, how you need to understand how to manage that risk, no? And maybe in this situation, since they receive a lot of money, they not necessarily has to allocate that in short-term loans. Well, maybe the type of investments should be more aligned to the maturity, the expected maturity that those deposits has in their balance sheet, no? So usually what we do in liquidity risk management is something kind of a liquidity profile for the company. So you have your assets, no, that you expect that maybe some loans are short-term loans, no, 6 months, 1 year. Some other are longer-term loans, 2 years, 5 years, 10 years, 20 years, I don't know, no? And then you make the same profile, but from your liabilities. And then without doing the whole picture and put it in a dashboard, you can just imagine that this bank, maybe they had like a match for the loans in some way, because for sure they had long-term deposit at some point. But this vast amount of short-term deposit that their clients have the right to withdraw anytime was amazing, was really huge to the as compared to the assets of the whole company. Actually, the total amount of these deposits, once again, was 173 billion compared to the total assets of 212 billion at the end of 2022. No, so definitely you should have investments that are easily to liquidate in the short term without damaging your balance sheet. And that was the huge mistake that unfortunately they did it. Definitely there was some ways to get out of that situation. Actually, they put on the news and announced to the market a plan to figure this situation out of to gain all the liquidity that they require to keep delivering the deposits or give it back the deposits to their clients. And actually the company were trying really hard to change that profile. No, the only thing is that unfortunately they were so deep into the water, and people start to talk definitely a lot about that situation, that the bubble just explodes suddenly.
Yeah, great. It's much clearer, I guess. And so it's a matter of asset management more than it is a concentration in sector, right?
Exactly.
Yeah,
exactly.
So do you think, I mean, with the benefits of insight, we say that humbly, but do you think it was very much predictable what happened? And do we have comparisons from the past that anyone could have, with some attention to history and monetary history, would have been aware
of? Definitely they were really optimistic about for how long they will keep those deposits. Maybe they were really optimistic about that this was just a base from where they will start to accumulate more and more and more deposits. No, and unfortunately that didn't happen. No, that's why they just said like, okay, let's gain more profits using a strategy of having zero or very, very low liability, which are these deposits, compared to the margin that they were acquiring with these investments that they bought in the previous years. No, definitely, since they were really optimistic, you can just watch the story and say today, like, yeah, definitely someone could see those numbers and say, what are you doing, guys? No, and maybe liquidate that vast amount of notes. I'm saying about 92 billion, that it is a huge number. That at the time that the Fed and the central banks, they know that they will start to raise the interest rates, well, they should just immediately take action and change the profile of their investment. Maybe they didn't expect that the interest rates rise so much. The inflation impact that we are living today everywhere would be differently, no? But I mean, maybe that's why a lot of people is calling to come back the regulation that we live from 2010 with the Dodd-Frank Act, sorry, no? And what was all around about making all these assessments about the situation of these kind of entities, that definitely the numbers that they manage are not insignificant, no, for the market.
Okay, what's your view? I'm interested. What's your view about guaranteeing deposits and moral hazard? Because we all wish that depositor get their money back at one point in time, but on a long-term perspective in economics, you have the problem that if the regulator, if the Fed is always going to step in and say, okay, guys, okay, I'm going to solve it for you. I mean, every bank, every banker, every asset management department is not going to be that worried about making mistakes and about playing it at high risk, because there's always someone else coming from outside saving.
Look, this is a very particular situation that you can see frequently in the US, because the US market is very innovative and they are very characterized as a risk takers. So, and unfortunately because of it, I can tell you, I don't have the exact numbers, but I can tell you that the amount of money that was circulating in the world economy in early 2000s, no, even after the dot-com bubble that we live at that time, nowadays is more than 10 or 15 times. And why is that? Just because, like you mentioned it, the regulators, they start to create all these incentives, no, and inject to the economy a lot of money to support these kind of situations. I'm not saying that necessarily what we live in COVID, for instance, it was wrong to help and to improve the capacity of consumption of people in the US, for instance, when they put this vast program of trillions of dollars to cascade to the whole economy and help the US market to cope, no, about that situation. However, it's just a lot of money, and the reflection of why there was such excess of cash flow in 2020 available for this bank is just because of it. A lot of money circulating in the market. You need to invest it somewhere. A lot of people decided to do it in the tech industry, and eventually it was cascaded to the SVB, and now we see the result of that situation.
And as you say, like injecting liquidity may create and does create expectations on future injection of liquidity. So you expect that amount to come in the future as well, but at a certain point, does it come anymore?
It's maybe something related what we just see during this weekend about the situation of Credit Suisse and UBS and the Swiss central bank. And there is now a huge discussion about what is happening with the Tier 1 notes issued by the Credit Suisse, because you would expect that since the seniority of these Tier 1 assets are on top of the shareholders should caution the whole risk, and then these other notes came out. But what happened? These structured notes, they have triggers. They have notes in the contracts, no? And then you need, as an investor, you need to be sure to understand the risk that you're taking. And it's basically the same thing that is happening when you are actually creating a bank account where you're actually taking the decision of put your money on, etc., etc. You need to be sure, and you need to be really aware about the risk that you're taking, no? So definitely, yeah, if you have like a father or grandfather that is putting all the money every time that you're messing up, yeah, for sure is something that it shouldn't happen all the time. And it doesn't generate the accountability that the market requires at some point, no? Which is your question. So eventually, it's like you require that all of us as financial professionals, we are accountable of our actions and make sure that we are taking into consideration all the risk if we are investing, or we are let our clients or our counterparties know all the regulation and all the small written in the contracts that can expose them to those different risks, no? So definitely, it's just to be aware about the situation, I think.
Yeah, sure. And you mentioned before Credit Suisse, so let's jump to Europe for a while. Like, what do you think are the main issues have been the main issues with Credit Suisse that led to this situation and the merge with UBS?
Well, this is a completely different story, no? And I think that I read we have read during these days parallels between what happened in 2008, which is completely different. It was a crisis about the quality of the assets, about what happened with SVB. That is what we are discussing about a huge liquidity issue, no, and how to manage that risk. And then in Credit Suisse, it was more about reputational risk that they have drained during several years, especially after 2008, all the financial institutions have changed a lot, no, it towards many things related to transparency, related to the controls, related to how they communicate information to their clients, the market, no, the transparency.
What did
that
they
I
do
just
in
mentioned.
particular that what did they do in particular that damaged, in your opinion, their reputation?
Well, Credit Suisse has been a bank that traditionally has not only the commercial or wholesale banking, but also wealth management and investment banking as part of the whole group. The problem here is that they have been one institution that continuously has been part of, I mean, not of scandals or news that are related to mix this business. No, you cannot be an active role. You cannot have an active role in different sides in the business. No, and definitely that is why some other financial institutions have split it completely. Their groups, they have sell what happened with GE at some point, like, okay, need to focus on our business, the industrial business. And here basically you can just review the news about 5 years and they have been part of bad suggestions to their clients, no, that have required a lot of, but they have lost a lot of money, that their clients lost a lot of money because of the suggestions that their executives or the people that are part of Credit Suisse have put on the table as a diversification or a higher earnings options when they invest into this kind of funds or this kind of operations. No, the only thing is that you can let your clients know that they have this kind of options. You can let them know what are the products and the structures that are available. But when you work on the side to structure these instruments, and then on the side of finding money to invest on those investments as well, you are walking in a very narrow line that you need to take care about how you communicate stuff with all the stakeholders. No, so that's it. Those situations, those scandals, internal issues also, no, among their executive staff. No, I remember that they have a couple or 2 or 3 different CEOs in the past 4 years, I think. Definitely drained a lot the trust, no, and the reliability of the information that everyone expects from that kind of institution. And it's a systemic risk institution in Switzerland.
Yeah, second biggest bank, right, by market cap after UBS.
No, and actually, you can check the numbers, the figures in past years, and that number, I mean, the amount of assets that Credit Suisse had was several times in the last decade. No, so the point is that definitely they have lost a lot of participation in the market.
You mean in the past? In the past, it used to be bigger than UBS.
Yeah.
Okay.
Sorry. Bigger than UBS, I cannot say that. I don't have the figure.
Because now it's like around half UBS.
Yeah. But the point is that the amount of their assets nowadays is just as a portion of what they used to have in 2008, 2010. No, and they have lost a lot of participation in the market because in Asia, just reviewing some information, I remember that Asia was a huge competitor of those resources that they had. Also because one of these situations that The Swiss banks were really famous in the past that are this information secrecy, and then you know that in the recent years, in the recent decade, the transparency about the financial information has been a very important factor to consider it in the financial market.
All right. The meeting was just stopped by Zoom that has this 40 minutes threshold. Talking about threshold, how much do you think that the threshold changed in 2018 during Trump's administration of moving it from 50 million to 250 million for banks regarding the Dodd-Frank Act may have impacted the current situation?
Well, definitely it impacts in an important way, because the definition about what is a small financial institution in the US is very narrow, because in the US nothing is very small, to be honest. Even the stakes in Texas. So the problem is that, no, I would say that definitely the capacity that regulators have to impose or to enforce the regulations, that is crucial. For sure, the institutions that nowadays they are regulating the banking system, like the Fed and the Office of the Control of the Currency, etc. Those institutions, they require a huge operative staff to actually enforce their objectives that are really important for the market. No, maybe at that point, not only the idea of deregulate somehow these small banks were in the mind of the government, was also like a relief for these kind of institutions. So yeah, definitely. I mean, especially in the US, having more than 4,000 financial institutions registered as a commercial bank is a huge challenge, huge. And especially, I mean, for those that are a niche institutions, maybe niche because of the sector that they work for, niche maybe because of the geographical area that they are servicing to, no? They require like an additional eye, no? Because the exposure that they have to just disappear suddenly is higher, to be honest, no? In markets that are not so so developed, no, you find only 20 different institutions considered as a commercial bank, 30 institutions, no? I remember in Colombia, before we had a crisis at the end of the 90s, we had certain of 45, 50 institutions considered as banks, and then we dropped dramatically until 15. And actually the number hasn't increased very much compared to the one that I just mentioned. Then in Mexico, you have exactly the same situation. And the control about these institutions that are capable to receive deposits from the public audience, it requires a special attention, no? So obviously you can just move this number however you want, no? You can just put it higher, lower. The point is that you give enough resources to those institutions that work towards controlling and overseeing this kind of market, especially in the banking sector, because everything is related about trust, no? About trust. And even if you have very small institutions and you create a snowball that 1, 2, 10, 20, no, that could be not so relevant in number in this very big market like the US, it can create a lot of noise. And now we have a lot of information sources that definitely creates a lot of noise and can generate panic easily, not only because of the biggest, but also I would say that because of any of those players that are out there helping the economy to grow, no?
Yeah. I mean, I think it's a common idiom among many languages that a tree that falls makes more noise than a whole forest that grows up, right? And the problem is
Definitely.
that the trust about other trees may be affected in this case.
And,
So
and, and,
whether
and
in
in
nature,
economy,
in nature, the trees keep growing, right? Despite that, but in banking, the other trees may fall as well.
yeah, no, and the whole thing is that after 2008, we had a completely different, the public audience have a completely different sentiment about the financial institutions. And that is the reason why, no, and as a reflection of this, you have a an incredible technology as it is the blockchain technology, no, that the main activity that that technology has nowadays is very focused on something that raised because the lack of confidence about the monetary system around the world, and that is a technology that it is changing the world about the security and the reliability of the information, no, and that should be really focused on that. But since the
Indeed, the
general
first, like the
audience,
famous Bitcoin white paper came out of in 2009, was popular, right
exactly,
after the crisis.
exactly. So it's responsibility of us as part of the financial system to generate enough confidence to the users of that system, no, and I mean, obviously, generate innovation. It's crucial for every kind of industry, not only the tech industry or industrial industry. No, also in banking and financial fintechs are very important. No, it's a reflection that we are keeping innovating in the products and innovating in the technologies, but everything, especially in this industry, is very based on trust, that people are keeping certain ethical standards, are keeping the technologies on the edge. They're using the technologies on the edge to manage the risk, no, and offer the best option for the customers. That's basically what we should do, no. It's a huge discussion that we could be part of in nowadays.
Absolutely agree. And one last question. You know
Mhm.
that there's always competition among regulators. When something bad happens in one country, and that does in that other country, politicians and regulators say, here we are better, see, we're doing things right. And you know, just right after some regulator in Europe was saying that the banking system in Europe is so strong, then the facts with Credit Suisse happened. But beyond the jokes, how
Mhm.
much do you think the European banking system is more stable, if it is, than the American one?
Maybe I can tell you that the regulation in Europe is more strict, and the boundaries are wider compared to those that you can find in the US. Because once again, the US is a market that is more a risk taker market. Is a market that definitely boosts and loves the innovation, no. And when you have all these regulation, these boundaries, yeah, you constrain somehow that innovation, no. um, I would say that in both markets, financial institutions are very strong, especially those that are systemic, with a systemic importance. Actually, Credit Suisse was in a good shape financially speaking. Nowadays, the capitalization, the solvency of the institution was really good. Their portfolio, they were behaving very well. The only problem is, once again, something that is not necessarily related about the quality of the assets, is about the behaviors of those who are part of the institutions, no. And yeah, these kind of things happen. Maybe what you mentioned, not having the idea that someone will save me easily, that definitely will guide in a different way the evolution and the innovation in this kind of industry.
It came to my mind a recent paper I read from PwC about risk taxonomy for the work I'm doing at the financial institution I'm working at. It was saying, be very careful at considering about the classification, the dualistic classification between financial risk and non-financial risk, because non-financial risk, the border is very nuanced, because non-financial risks end up being financial risks. And that's exactly what you taught us today about the Credit Suisse case.
Now you need to take into consideration SEGs, no? The impact on the SEGs. So yes. the impact in environment, governmental practices. Governmental practices is basically what is going on with Credit Suisse, no? And definitely that is the kind of thing that not necessarily are 100% attached to the main objective of these kind of institutions. But nowadays everything is just integrated, everything is linked. And now we find a lot of information that can actually create this kind of situation easily, So yeah.
Vincent, thank you very much. Thank you for being here with us. It's been great for me. I learned a lot from this talk with you, and I'm sure a lot of others did.
No, Andrea, thank you so much for having me again. And yeah, anytime. I hope to talk to you soon.
Thank you.